Picture this. It's 11 p.m. and you're scrolling through your phone. Some guy with slicked back hair is yelling at the camera, "This one stock will make you rich by 2030." No context, no numbers, just vibes and a Lamborghini in the background that's definitely rented. And on the other end of the internet, there's the opposite problem. Some finance forum telling you the only safe move is index funds. Forever, no exceptions. Don't even think about picking individual stocks. Here's the thing though. Somewhere between get rich quick and never try at all, there's an actual answer. Real companies, run by real people, with real numbers you can check yourself. And today I went through a full institutional grade research report, the kind hedge funds pay analysts to produce, and pulled out 5 companies that could genuinely outperform the market over the next 5 years. Not hype, math. My name is John. If you're someone who wants to actually understand what makes a stock a long-term winner instead of just chasing whatever's trending this week, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Quick disclaimer before we start. I'm not a financial advisor, and this isn't personalized advice. This is me walking you through real research and real numbers. Always do your own homework before putting actual money anywhere. All right, let's start with what these 5 companies actually have in common. Wall Street calls it a compounder, a business that can reinvest its own profits year after year and grow faster than the market almost automatically. The kind of company where, if you'd bought it a decade ago and just forgotten about it, you'd be thanking yourself right now. Let's start with number 5, TJX companies. You know them as TJ Maxx, Marshalls, and Home Goods. Here's what's interesting. TJX isn't really a retailer, it's a liquidation machine. Over 1,400 buyers roam the globe, scooping up excess inventory from more than 20,000 vendors, then reselling it at 20 to 60% off. Last year, that machine generated $60.37 billion in revenue and a jaw-dropping 61.2% return on equity. For comparison, most healthy companies are thrilled with 15 or 20%. And here's the twist. Rising prices are actually good for TJX. When people feel squeezed by inflation, they don't stop shopping. They just trade down. Economists literally have a term for it: down trading. The stock trades around $151 at a forward PE of 29 times earnings, which sounds pricey until you realize its historical average is 47.8 times. Analysts have a strong buy consensus with an average price target of $179.58. Score from the report, 8.4 out of 10. Number 4, Chipotle. Now, stay with me here because this one just went through something dramatic. Chipotle did a 50-for-1 stock split earlier this year, and then the stock crashed nearly 40% right afterward. Sounds terrifying, right? But here's what most people don't realize. The crash wasn't really about the business, it was about commodity prices. Beef and avocados got expensive, and margins dipped from 26.2% down to 23.7%. Temporary pressure, not a broken company, because underneath that, Chipotle still owns 100% of its restaurants, no franchising, no revenue sharing, and it's rolling out something called the Chipotlane, a digital-only drive-thru that's boosting order volume without adding labor costs. The stock now trades around $34, JP Morgan upgraded it, and the street consensus target sits at $43.50. Nearly 30% upside from here. Score, 8.4. Number 3, Fortinet. This is cybersecurity, but with a twist most competitors can't copy. While other firewall companies use generic off-the-shelf computer chips, Fortinet designs its own custom silicon in-house. That means their hardware processes security threats faster, using less power at a lower cost to build. The result? An 80.5% gross margin. Genuinely elite, even for tech. Revenue hit $6.8 billion last year, and their high-end firewalls saw a 41% surge in one quarter alone, driven by companies rushing to secure their new AI data centers. Score, 8.6. Number 2, Copart. Now, this one sounds boring on paper. It's a salvage car auction company. But stay with me because the moat here is almost unfair. Copart owns over 19,000 acres of land specifically zoned to store wrecked vehicles. And here's the thing. Cities almost never approve new salvage yards anymore, which means Copart's real competitive advantage isn't technology. It's dirt. 19,000 acres of dirt that nobody else can replicate. And here's a growth driver nobody's talking about. Modern cars are so packed with sensors and cameras now that even a minor fender bender often costs more to repair than the car is worth. So insurance companies just total it, and it ends up at Copart. That total loss frequency hit 23.6% this year, up nearly 5 full points in just 4 years. The stock got hit hard recently, down 40% from its highs after a surprise CEO exit, but it's now trading at $29, an 18 times earnings multiple, compared to its historical average of 29.2 times. Analysts see fair value north of $41. Score 8.7, and number one, according to this report, Qualcomm. Yes, the chip company that's been inside your phone for 20 years. Here's why it ranked highest. Everyone still prices Qualcomm like it's just a smartphone parts supplier, giving it a conservative 20 times earnings, while pure AI infrastructure companies trade at 50 to 70 times. But Qualcomm just unveiled something called the Dragonfly C1000, a server chip aimed directly at AI data centers, with a stated goal of $15 billion in annual data center revenue by 2029. They've also got a $45 billion automotive pipeline already lined up. After Qualcomm's investor day this year, JP Morgan raised its target to $265. Benchmark went even further to $300. The stock trades around $186 today. Score 8.8, the highest of all five. Let me give you a simple analogy for why this whole list actually makes sense together. Think of these five companies like five different kinds of toll booths. TJX is a toll booth on discount shopping. Chipotle is a toll booth on fast, healthy food. Fortinet is a toll booth on data security. Copart is a toll booth, literally on land, for the used car industry. And Qualcomm is a toll booth on wireless technology itself. None of them are chasing a trend. They're charging rent on something the economy can't function without. Now you might be thinking, okay, but every one of these has real risk, right? And you'd be correct. Fortinet's stock is already up huge, so a slowdown could hurt it badly. That's exactly why this isn't a buy blindly video. It's a here's what to actually research video. So let's recap quickly. Number 5, TJX, proven defensive compounder. Number 4, Chipotle, temporarily bruised, structurally strong. Number 3, Fortinet, premium priced, but justified by margins most companies would kill for. Number 2, Copart, a physical monopoly hiding inside a boring business. And number 1, Qualcomm, a chip giant the market still hasn't figured out yet. Here's the bigger takeaway. The stocks that actually build wealth over 5 years rarely look exciting on the surface. They don't trend on social media. They just quietly compound, year after year, while everyone's watching the flashy thing instead. So, if you found this breakdown helpful, make sure to hit subscribe. And I'm curious, out of these 5, which one would you actually want to dig into further? Let me know in the comments. Because the best investors aren't the ones who find the hottest stock. They're the ones who understood the business before anyone else was paying attention.